Where's that coming from?
That's harmonica music.
I love that. We don't have nearly enough harmonica music on this.
You know why we have harmonica music?
Well, we've been looking for a reason to have harmonica music for a long time.
I don't know. It just sort of worked out this way. Let's rewind and talk about where we're getting to this. It's a focal point in the
Nothing to do with harmonicas, by the way.
The focal point in the Martha Stewart case has been whether or not she had that prearranged agreement to sell shares of ImClone.
But forget about the discussion of handwritten notes and who decided what and when. There are plenty of trading tools for this purpose that Martha or anyone else could have used or can use.
And a lot of investors don't take advantage of them. Joining us now to talk about going beyond the market order is Scott Carney. He's president of HarmonicTrader.com. A poor excuse for harmonica music.
As our viewers know, we don't really need much to go that way. He joins us from Tucson, Arizona. Scott, good to talk to you. Thank you for being with us.
Good to see you guys.
We're getting we tend to get caught up in these trials and the fame about them, but really this is not an insider trading trial, as a lot of people have forgotten. This is about, this revolves around a stop-loss order that Martha Stewart and Peter Bukanovic say existed and Douglas Faneuil says didn't exist. Let's talk about limit orders and stop-loss orders and things like that. What is a stop-loss?
Well, stop-loss order is a predetermined order that you place that is supposed to protect against some downside risk. And what happens is that when the market reaches that particular price, the order becomes instant market order, meaning that regardless of what the price is at, the trade gets executed. And it's normally used to protect against dramatic downfalls like the Martha Stewart case.
Yeah, I guess the thing about these that we wanted to draw people's attention to is that you can use these. So many people just put in market orders, whatever they're buying. They watch the stock, they watch the ticker, they get quotes on their internet, and then they'll put in the sell based on that. You got to decide when to use them and what the risks are, but you can sort of have the eyes of your broker or the eyes of your broker's computers on the market round the clock, keeping an eye on these things and executing your orders if your instructions come your way.
That's true, but placing a stop-loss order is always effective for minimizing downside risk, especially in dramatic cases like the ImClone stock. And, you know, although that the stock had dropped dramatically the day after following that news announcement, it still would have prevented the extreme downside risk of what eventually happened to ImClone as it sank dramatically lower after that announcement.
Scott, I want to put up a 1 month chart here on Sienna. It's a stock in the news today, and maybe use that. It's not a perfect example, but it's perhaps an illustration of where you might use what's called a trailing stop loss. As a stock rises, you can decide that if it's particularly volatile, you want to set a price at which, if it falls that much, you're going to sell because you're worried that maybe there's some bad news for the company, and you just want to have an amount set where you'd get out even if you weren't watching the stock yourself at that time. So Sienna was on the rise, a general uptrend there, and then all of a sudden this bad news today, and it drops off the right side of the chart. Tell me about a trailing stop loss and what the strategy is. How far behind the market price might you put a trailing stop loss in?
Well, trailing stop loss is a real effective strategy to protect profits in a position that is moving steadily higher if you're long the stock. And in the case of Sienna, there would have been a good strategy to have a trailing stop in there in such an event. Now, the problem with a limit order like Sienna is that if you had the trailing stop placed slightly off of the high or slightly off of the basic trend of the stock, and it falls like it did this morning, what's going to happen is, even though it traded below that price, your limit order is still going to get executed.
As a market order at that point.
As a market order,
right.
Exactly. And although it's not going to be exactly at that trailing stop limit order that you place, it's still going to protect against extreme downside, as Sienna exemplifies.
Scott, this sounds terrific. For people who haven't done this, sounds like a great way. If you happen to go on vacation, you're at least protected from rapid downside. The problem is if you're in a volatile stock and your trailing stop, you keep moving that stop up too high too close to the trading price, you could get out of a stock on a small drop only to find that you got out of that stock too early.
Absolutely. Those are some of the perils of trading. However, the trailing stop and a stop loss strategy are very effective because it makes the investor take responsibility for the position. I mean, either the stock's going to work out or it doesn't. And a lot of people tend to invest in stocks and then just kind of let them fly and not be willing to take a responsibility for that position. And if a stock falls 30 or 40% and they're not protected on that downside risk, then they're exposing themselves to a lot of potential trouble.
And Scott, we can turn this around, and you can use this for buying stock as well. If you decide that you've got your eyes on a particular company, but it's just trading too high, you still want it. That's another thing that a lot of people don't take advantage of. You can put in an order that says, when it gets down to this price, give me some of this stuff. Exactly.
That's known as a limit order, and that's a great strategy for following a stock that you might want to pick up. And if a stock seems to get away from you, you can execute buy limit orders that'll help you follow the trend.
Scott, good to talk to you. Thank you for joining us to clear this up a little bit.
Thank you very much.
Scott Carney is the president of HarmonicTrader.com. He joins us from Tucson, Arizona.
That's a big discussion.
Yeah, it is. And this is just to whet the viewer's appetite. If you don't know about these things, you talk to your broker about it. Most of the online brokers will have somebody who can explain this to you, or just get on the web and research it. There's some really good, clear explanations. Yeah, don't go run and do this until you really get why it could be good or bad for you.
If you want more on the topic, though, tonight, 5 o'clock Eastern Time.
We're doing it on your money. We're talking about trading techniques like stop losses and limit orders. We're going to break down these and other trading terms, show you how they can be part of your buying and selling strategies, and I'll have a panel of experts on hand to take calls and emails on how these strategies can work into your own portfolio. Tune in at 5 Eastern tonight.
A lot in store on this program today, including the gaming sector, and a look at why Lady Luck has not been on its side lately.
Our stock of the day, a place where you can also bet on the future and future.